Are you into real estate and you've heard about its collapse and hundreds of billions of imaginary dollars wiped out in under 12 months? Luckily for you, Real Talker, this video is for you. Here we'll talk about the collapse of real estate IPO and SPAC stock and the question, do real estate buyers still suffer losses? Collapse of the real estate trading SPACs and IPO. Even on the most glorious of Fridays, 2 days after a big rally has retracted 5 days that saw a sharp decline. Shares in a real estate tech stock undergo a 23% collapse after having already collapsed months before. Opendoor Technologies, or Open, a company that provides digital platforms for residential real estates and developed a service model for real estate buying and selling on a mobile device. The company ended the year with an inventory of 17,009 unsold houses in the fourth quarter, and on Thursday evening reported a loss of $191 million for Q4. This is bringing their net loss for the year 2021 to $662 million, which brings their total losses for 4 years that have been publicly disclosed to $1.5 billion after only 3 years in existence. Opendoor first went public in December 2020 at an IPO price of $31.47 amid a lot of hoopla, but shortly after the stock reached $39 by February 2021, it started dropping along with other high-flying securities. The Securities and Exchange Commission, which had related to many of the big ones that popped. By February 2021, when the market started coming unglued beneath the surface as high flyers started collapsing one at a time, each on their own schedule generating widespread chaos across the market. As was the case in past financial crises, Opendoor, not surprisingly, has seen its shares slowly reach record highs amid intense public interest. The collapse in real estate in May of 2021 was just a chapter in a long extended story. On October 5th, Spreader shares closed at $8.44, down 28% from the most recent peak and 74% below its IPO price. But beyond this fire sale is a broader collapse of the real estate sector, with SPAC stock down 73% from its August 2021 IPO price. With real estate on the verge of bankruptcy, we've seen massive decreases in employment and asset value among companies. Not even taking into account stock valuations, real estate has become a different market. Many companies have been failing, and wise investors have begun throwing markets in the dumpster and pulling out the money they had put in things like gold. Opendoor reported in their SEC disclosure that it acquired 36,908 houses a year ago, but sold only 21,725 homes in the year. The unsold 17,009 homes still left over are valued at $6.1 billion, and many feel that this was an IPO flameout due to its high number of houses being purchased with no intention of selling them. Unfortunately, because it still owns 17,009 unsold homes worth $6.1 billion at the beginning of 2023, Opendoor seems to have run in debt. How can this be rectified? With this new model of financing, Opendoor's inventory uses non-recourse debt backed by its houses. These loans are structured in a way where if Opendoor defaults, the lenders get the houses and cannot go after other assets such as company stock or cash. With non-recourse loans, leveraging their real estate assets and company debt against these loans allows SPACs to take on property as assets. Opendoor financed this inventory with $6.1 billion in non-recourse debt backed by its houses. Non-recourse means if Opendoor defaults, its lenders get the house and cannot go after Opendoor's other assets. If Opendoor is unable to sell those homes and pay off the debt with the proceeds, it can hand the properties to the lenders, letting them worry about selling the homes. Regardless, Opendoor has fared a lot better than expected by giving investors SPAC fraud greater peace of mind. Opendoor will be searching for similar properties in order to sell them at significantly lower prices that yields a roughly 5% gain on the property. Opendoor claims these new properties would need minimal renovation as they're in better condition than most of the rental homes already on the market. The company searches for similarly structured homes and prints off QR codes that offer further information. In addition, Opendoor was under contract to purchase 5,411 more homes for $1.9 billion. Trouble with the stock market led to a lot of real estate companies ceasing doing business without properly developed homes for sale. About 2/3 of the 17,000 homes have been finished for resale. 1/3 is not completed but is still usable. Not every home entity is ready for sale at the onset, but that doesn't mean a finished home goes to waste. A completed home can remain active on the market and continue to generate income while waiting to find a buyer. In the first quarter of 2018, new home listings in Metro Denver fell by 47%, according to Zillow. The number of homes that have changed their status in the supply or still show unsold homes remains large, with 17,000 verified listed and 7,400 verified unlisted properties under a holding page where those who can claim them are invited to bid. With the huge collapse of the real estate IPO and soon-to-be SPAC stock, there still is a lot of good value to be found in some cities. With their 6-foot walls, these homes are virtually untouched in comparison to many that are vacant. Zillow's business model has affected real estate transactions across the board. Unhappy homeowners who previously dreamed of becoming landlords are now looking for other companies with similar products. This has led to an IPO, and SPAC stock has seen staggering drops in value. Meanwhile, online competitors are able to sniff out and enter the real estate bubble with ease, while the traditional media is abandoning their own promises, largely because of their reliance on sponsored content and not their expertise in data analytics. The traditional house flipping business is complicated by the number of bricks and mortar inventory that are no longer for sale or show up on the market for a long time, even though they have been completed and left vacant. And what happens when demand increases and that doesn't happen? Predictions in the investment community see an inevitable collapse within the markets as inventory piles up and buyers can't find anything new. Too much traffic on the real estate market creates a flood of homes stuck in the house flipping pipeline and causes price to dip, which also affects inventory. Inventory is scarce because it's difficult to find homes for sale, and they don't show up as supply. House flipping is easy. The first part, buying the house, when money is no object and your algo can spend as much as it wants. The rest is hard, and making money at it is even harder, especially if you overpaid in the first place. This is an activity that isn't suitable for people who write algos, it turns out. It's easy to enter into the house flipping game when it comes to house flipping properties. The hard part is making money on a large scale. AI allows you to make a better decision in terms of how much you spend on the remodeling and sale of your houses. At the height of the real estate market boom, Redfin had even rocketed their share prices. Stock jockeys created false hype about the fast change in fortunes for those using algo-driven house flippers, and a February surge pushed shares up to an eventual high price where you could buy a whole business. Redfin rode the algo-specific house flipper wave in 2020 and saw its stock reach a high of $98.44 in February 2021. It became the red-headed stepchild at the IPO table later that year. Shares of a stock used in the real estate industry attributed to various shareholders and traded on financial platforms such as the New York Stock Exchange and Nasdaq began a long rebound. On Friday, it closed at $21.83, having collapsed by 78% in 1 year. The disaster that had been previously believed to be unimaginable surprised many investors who were more experienced with the stock market. On February 10, 2019, Zillow announced that the company lost $881 million in 2021 on its home flipping escapade, which came unglued in November 2021 when it disclosed that it would lay off 25% of its staff and get out of the house flipping business. The company also stated they will dump the 7,000 homes and properties they bought. However, while they were accepting cash, the potential SPAC investors are now finding that their purchase is being absorbed by institutional investors. These investors may need fewer homes with tighter budgets when under pressure. Some of the empty houses could end up on the rental market as well. On one hand, single-family homes and department stores have seen price increases in the past few years. On the other hand, this real estate company may have deceived investors by selling vacant homes off to investors during a boom time when inventories are low. Once these houses are sold off, they are no longer on the market and don't show up publicly as vacant either. The collapse of the real estate IPO and SPAC stock seems to be coming to an end, after investors won in a 3-day trading row with shares recovering some losses. Shares finished today at $57.95, down 73% from their high a year ago, with the SPAC losing back somewhat more by closing at $139.49. Share prices dipped on the Monday, following the IPO before bouncing back brilliantly. Share prices have only found movement alternately up and down between extremes. Because of the volatility of share prices, Stoned offers both long-term buys and sells to investors. A new breed of technological solutions to Wall Street has emerged, which called itself a tech company reinventing the space. One realizes that something is seriously wrong with the Wall Street. The success and continued growth of this trading app opened up a multi-billion-dollar dialogue on what it means to work as a broker in modern-day financial transactions. The test has not yet been passed when most inventors realize that something is seriously wrong with Wall Street. The rapid decline of Compass, a real estate broker, during the public market collapse showed how far you need to go back in time for historical milestones to make sense on this beaten-down, battered field. Compass is making losses that exceed the size of SoftBank's investment in it, and the only hope for Compass is that City Mellow stops using their locations, which are more valuable than retail locations because they have roof meter boxes. Despite the help of these investments, Compass bought up brokerages around the country who were looking for a white knight purchaser to save them from bankruptcy, but could not find one because they found new buyers. Some might be attempting other public offerings in hopes to raise even more money and potentially replenish their losses. The collapse of two core players in red-hot real estate IPO and stock market caused a loss for some investors who are looking for safer plays. Compass shares peaked on their first day of trading following the IPO in April last year at $22.11 and have declined ever since. On Friday, they closed at $7.65, having plummeted 65% in 10 months since high. With low function sets, Compass shares are currently around 58% below their IPO price of $18 a share. As prospects for the company look grim, investors should be wary of pouring money and making up company names. The stock is predicted to be worth just under $1 over its lifetime. Lemonade, which is hyped as an insurance tech company and sells insurance for renters, homeowners, and pet owners, etc., went public in July 2020 and $29 a share. In the first day of trading amidst immense hoopla, spiking 139%. It then continued to spike until it reached $182 in January 2021, and then came February 2021 when this whole show started unraveling. The securities offered in this offering are not suitable for all investors. Most of the securities are not publicly traded with any regulatory review or oversight and will likely be subject to emergency trading restrictions as well as other regulatory limitations. Investors should carefully review any financial statements and the risk factors below to make an informed decision about whether to invest their money. On Friday, shares closed at $23.48, down 83% from the high and 90% below the IPO price, at which the shares never even traded because the first trade was at $50 a share. Tech stock pundits lamented how much money the company missed out on as a result of this mispriced sale. After the collapse of an IPO in the real estate industry, the stock prices of SPACs plummeted. The first publicly traded shares of SPAC had gone over their production value, with a $50 maximum purchase price. This caused some tech stock pundits to call it a mistake and lament how much money was left on the table. Better.com is a tech mortgage lender backed by SoftBank that had shares scheduled to close for sale after their merger with the SPAC, which postponed in December 2021 after the CEO fired 900 employees, most of them in India via a Zoom meeting. With the SPAC merger, and therefore the inflow of cash having been delayed, the company raised $750 million from SoftBank and its heavily invested shareholders because these sort of companies constantly burn large amounts of cash and constantly need new cash to keep burning. The company is preparing to merge with SPAC, a company specializing in the purchase and acquisition of distressed debt portfolios. The hope is that now the portfolio can be leveraged for stock like it did during their last sale. Many national real estate businesses have filed for bankruptcies because of the declining value of their holding and higher borrowing costs. However, some people assume that SPAC will be happy to buy them up and get in on the ground floor, even if it doesn't make any sense commercially. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!